When it comes to investments, we're quite uncertain as to where we should invest: debt or equity, and how much? Gold or real estate? Again, how much? What should be our portfolio? What is a perfect portfolio? We'll discuss all these things in today's Investors Hangout, and you will be able to find what is the right asset mix, or what is popularly known as asset allocation decision. This program is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. My name is Rajesh Lake, and with me is the CEO of Value Research, Dhirendra Kumar. Dhirendra, welcome.
Thank you.
So, is there something called a perfect portfolio?
Yes, one should actually strive for perfection, but there isn't a thumb rule. There isn't a formula. There isn't a something that you can arrive at with precision that this much should be equity, this much should be debt. But it's important to have those principles in your mind. One is that what is the different kind of asset classes.
Right.
A lot of people think that equity people understand, debt people understand, but people don't understand the underlying how it actually functions. Uh, a lot of people think that commodity is also an asset class, or gold is an asset class, or real estate, and they are an asset class because they are a repository of value. But from an investment point of view, from an investment angle, they are not. I think
Okay.
For individual investors, I think one should keep it very simple. Wherever equity is, when you become a owner, whether you buy the stocks yourself, or you buy a equity mutual fund, or you own a business yourself, you are the equity holder, you are the owner of that business. Whenever you are lending the money, you are a debt, you are investing in debt, whether it be a bank deposit, whether it be a company deposit, whether it be a government bond, or whether it be a bond fund. So this is something which you have to understand, that you become a owner or you become a lender. This is the fundamental thing which you need to understand. And when it comes to becoming an owner, it comes with a certain set of risk, and there are mechanism of reducing that risk. You diversify, you do your SIP, you average it, those kind of things, and make sure that you're investing your long-term money in equity, because equity will not produce or will always surprise you in the short run, because
Right.
there is no basis to it. Fixed income, predictable. You will not get superlative return. You will not become the benefits of ownership. You will not get huge rewards, but you will definitely, not definitely, but depending on the kind of lending you are doing, if you are giving your money to somebody who is not, who is not trustable, then your money will be, of course, you will be expecting that you will be getting a return. You will be expecting that you are giving it to untrustable person, then you will be getting a higher return. That is called credit rating.
Okay.
If somebody is highly rated in terms of his ability to repay the interest and the principal on time, then it yield lower return. So how much risk are you taking? And so you are lending money and you will get a fixed return. That is why debt is also called as fixed income. Then comes gold and real estate, which is a popular asset class, but you should have a little bit of gold. And gold, I think, in India, the way it is held, should be looked upon as a consumption.
Okay.
There are reasons why you should not look at it as an investment, because of course it is, the cost of buying, the gold, the form in which we buy, has 10 to 15%, even 20% making charges.
Okay.
Your ability to realize the value of it when you need the money may not be as simple as liquidating your deposit, or redeeming your mutual fund. Then comes real estate. Most of us have thought in terms of, come across all those stories that somebody bought a house and now how valuable it is. Mind you, this is of course real estate. You should look at it as a house. One should have a house, but as an investment, I'm not so sure, because whenever we talk of those lofty returns, we talk of 15 years, 20 years, 25 years. You bought a piece of land and it has become valuable, and what we miss out on is the 20 years time period, 15 years time period in which it has become valuable. If you would have held even Sensex, an unmanaged index, it will be that much. Think of Sensex as recent as 2003. It was at 2,800, and today it has crossed 30,000. So look at this appreciation. But we don't look at market in these time frame. Whenever you look at market in these time frame, add to it the convenience. Add to it that it comes with no maintenance. You don't have to worry about it. You don't have to worry about paying the property tax. You don't have to worry about keeping it, the upkeeping of it, looking for a tenant, and then realizing it when, if you want to sell, can you sell it at will, and then all the returns in equity or long-term equity investment comes to you in the form of a tax-free return. So going by the convenience, so I think investors should do themselves a favor. If they are looking at investment, they should only consider equity and debt. You should have a little bit of gold, enjoy it. Have a house, live in it. If you are able to save on rent and live in that house, good enough. You have also an asset class on which you can bank on. Nothing beyond that. Don't look at real estate and gold as an investment.
So it's quite a myth, according to you, that when investing into a property and all will be like you'll benefit the most out of it. That's a general myth people have.
That is, and that myth actually, and it is not untrue. The real thing is that the behavior of investors when they buy a house or buy a property, you are thinking long term. You can't get out of it, and you end up benefiting from that.
Right.
But you don't think like that when it comes to, if you are disciplined. So I would say that, and today I think it is risky, because the kind of risk which you are assuming while taking a position in real estate as an investment is that you are taking a bet on the builder. Your inability to diversify, it's a big ticket purchase. You when you buy a mutual fund, when you invest in a mutual fund or you buy a stock, you diversify. But when you buy a flat or a house or a land, then it's the quantum of money that is at stake is very significant. So if you go right, it's fine. I think it is not a myth, but it is not appropriate for most individual investors trying to do accumulate their savings with their 5,000, 20,000, 50,000, or their lifetime savings accumulating to few lakhs and maybe even few crores. But that is not an appropriate vehicle through which you can diversify, have all the controls, liquidity, tax efficiency. So those things you don't get. So it is good to keep away from that.
So what you're saying is that in the asset allocation, we should have debt and equity,
Equity.
a bit of gold.
Have it in the locker, enjoy it.
Wear it.
It's actually a security. It's an investment of last resort. If I just think of some situation, physical gold, not the government. Of course, if there are different forms in which you can have gold.
Correct.
You can have a gold fund, then you can have a gold ETF, then you can have a sovereign gold bonds, and then there were and then you can have physical gold, and then you can have jewelry. Jewelry turns out to be the most inefficient way of holding it. Physical gold in the form of a coin or a bar or something works, but liquidity, I'm really worried. Of course, purity may not be as questionable as you're getting it from. Sovereign gold bond turns out to be the best, because you are able to write, but you don't enjoy it. You don't own gold. The joy of owning gold, which is the prime motivation for people in India being a huge gold consumer.
So apart from this, in the asset allocation, are there any other asset that
No.
we should be taking
Investors should
care
look
of?
at fixed income and equity only. And how to go about allocating is critical, because the basic rule to follow is your convenience and your expertise.
Correct.
So long-term money, and long-term we defined a couple of weeks back that any money which you are unlikely to need for 5 years and more should be considered long-term. Keep that money in equity, and remaining money, all the money which you are likely to need in foreseeable future, which is within next 5 years, I'm just putting a number, a time period to it. Keep that money in fixed income, because you can't bank on the market for the short run. Now, how to mix it up, because everybody needs fixed income, even if he's a long-term investor. How much? Because that depends, because we talked about why invest in a balanced fund which is 30% fixed income, because most investors are not comfortable. All said and done, when you see the big swings, and particularly the downswings of the market, it's scary. So it's important that every long-term investment in portfolio should also have a fixed income allocation, to the extent that it makes you comfortable. The simplest way of doing it is having a balanced fund for your long-term investment. If you are investing and you're a very conservative investor, you don't want to take chances, consider those MIPs, which are which is a converse of the balanced fund. It is 30%, 20 to 30% equity remaining in fixed income. It will not get you the tax efficiency, but it will never give you those big declines.
Okay.
You will be able to generate more return than fixed income. Your money will not be, and even if you're thinking in terms of little over 5 years, you are likely to generate superior return, even tax efficient, and particularly the tax efficiency which comes from a mutual fund structure. Because when you invest in a mutual fund, all your returns becomes tax free.
Right.
When you invest in a deposit, all the income is taxable in that year.
So
all the interest income.
So how does one arrive? Okay, is there a formula? Is there something that one has to keep in mind? How does one arrive at a suitable asset allocation?
There isn't a formula, but
Yeah.
I would like to, I'm quite tempted to give a formula so that, people can, because
Yeah.
this is such a ambiguous thing that not having a formula, if investors get a formula, then they might follow it, and then they will be able to keep on track. But I think more than the formula, it is important, if you choose the appropriate kind of fund, you will have the formula embedded. Because if you're a long-term investor and you are comfortable with the ups and downs of the market, you are willing to take chances, you will not be upset with big swings in the investment value, then it's fine, building a portfolio of large cap, multi cap and small cap funds, and even having 90% of that money in those, and 10%, a small fixed income allocation of 10%.
Okay.
If you are a conservative investor, investing for the first time and accumulating, doing your SIPs, always start with a balanced fund, because here the formula is embedded in the product. The balanced fund will make sure that your money is always no more than 70% into equity, remaining in fixed income. If you are an extremely conservative investor but getting disappointed with the low return of fixed income, wanting to enhance your return, go for that MIP, because that will make sure that you are not exceeding 20-25% in equity, remaining in fixed income. So you will not. So that formula is getting embedded in that. If you try and implement these formulas yourself, if you decide to have 80% into equity, 20% into fixed income, then you will have to be more proactive. When you're 80%, because equities, when they go up, that 80% will become 90%. Then you will have to redeem a part of your equity, put it in fixed income,
Okay.
rebalance it yourself.
So
It
always
might be
maintain 80-20 ratio.
yeah, that 80-20 is for the long term investor who is still comfortable, because many investors, when they see the market rising, they think that they can be 100%. It's not a wise thing. So build your asset allocation based on your tolerance, how much experience. And I think it's also a function of two things, which is intangible, why we can't have a formula. If an investor has been in the market for 10-12 years, he has seen the ups and downs and has benefited from that, he will have a far greater belief in the decline and this rebalancing approach. The other is, how important is that money? Even if you're a long-term investor, but what is the scale of money? If this is the only money that you have, assuming that I am investing for 10 years or 20 years, and I'm investing 2,500 rupees with great difficulty, which is about 30,000 rupees a year, that money becomes 5 lakh rupees. When that 5 lakh rupee, after 4 years of accumulation, or 3 years of accumulation, it actually becomes, goes down in value by 20% or 30%, the sheer importance of that money in my life framework is so critical that I will be acting in a haste.
Okay.
So these two things actually differ from investor to investor. How important is that money, and how experienced are you in the market? Once you have, so depending on that, err on the side of caution. If that important money is very important, you don't need to move beyond the balanced fund.
Okay.
It will help you stay on course. If you are reasonably experienced, then maybe. But the combination of these two things actually makes investing, even through mutual funds, reasonably sophisticated, because you have to experience importance of that money. These two things generally don't get factored in our planning.
Okay. And how much does the time factor, time horizon play in this formula?
Time plays a crucial thing. The starting point is that you should be doing this long-term allocation for your investments, because anything less than 5 years, it should
And we
get into fixed
discussed how
income. Yeah.
long
How
should
long
one
should be
be
long term?
invested? Yeah.
Then, as you get closer to your goal, start moving that money. Exactly the way you accumulate gradually, you should, redeem and take your money out gradually. And that is something. So as you get closer to your goal, and once it comes in a vicinity of 3 to 5 years, start pulling that money out gradually.
Okay.
And that will change your asset allocation.
So,
And changing that asset allocation means redeeming your money and start putting it in fixed income. So it's working, but working and finding its place in a manner, in a kind of fund, in a kind of investment which is predictable.
so would I be right in saying that one's ideal asset allocation must keep changing with time,
Yeah, absolutely.
with the horizon of my goal?
Absolutely. And but there are, yeah, yes, as you get closer to your goal, and assuming that you have accumulated all the money, and you have reached and you have accumulated the amount for which you are saving, or you are doing your gradual investment, then as you get closer to that, it should be 100% into fixed income. And if it is 5 years away, then it should be that 80-20, 70-30, or 30-20, whatever you have decided to be.
Okay. And are there any mutual funds that make the job of asset allocation easy?
Yeah, what I was referring to is MIP, the balance
Okay.
fund, or the
Okay.
equity income fund.
Okay.
They do it automatically. You don't have to bother about rebalancing yourself.
Okay. So I hope viewers, you've been able to figure out as to what is the right fund mix that you should have. And as Dhiren said, it should be a mix of equity, debt, bit of gold, and of course, you should have a house of your own.
Yeah, yeah.
So these four factors are important. Time horizon is extremely important. You have to ensure that you are invested for at least, if I go back to the programs that we did, at least for 5 years you need to be invested.
That's the definition of long
Definitely,
term,
yeah,
and
yeah.
that is something which should be generally more equity oriented. A majority part of your investment should be in equity.